and welcome to this edition of Startup Central. I'm Athera Rai. This is the only show of its kind on Indian television dedicated, of course, to startups, innovation, technology, basically anything to do with the new economy, and it's going to be here on your favorite channel, ET Now, every weekday at sharp 6 p.m. Like all the stakeholders of the community that we get on the show, the team that puts the show together, the Startup Central team, thrives on constructive criticism. So keep writing into us. We love getting your emails. Our email address right on top, suc@etnow.tv. Winter is here for the startup ecosystem. This is what Gaurav Munjal, the co-founder and CEO of Unacademy, wrote in a letter to all employees today. Talking about the larger environment that is at play, he writes, and I quote him, "Winter is here. Tech stocks globally are crashing and burning due to tighter monetary policies and rising interest rates. We're looking at a time where funding will dry up for at least 12 to 18 months. Some people are predicting this might last for 24 months. We must adapt. This is a test for all of us. We must learn to work under constraint. We must focus on profitability at all costs." Remember, Sequoia Capital, one of the investors in Unacademy, has come out with a 52-slide long presentation talking about being obsessed with road to profitability. And this is Unacademy, one of Sequoia Capital's portfolio companies, within 24 hours of that, penning this letter to all employees, saying winter is here, funding may dry up, and we must be profitable and adapt at any cost. So what are the goals and how does Unacademy plan to do this? And here is what Gaurav Munjal wrote. "We have significantly reduced our brand marketing budget. We will focus on organic growth channels instead. Every test prep category that we run will become profitable in the next 3 years. Unacademy centers should be profitable in FY23. That's this financial year. Remember, the Unacademy offline center started this year. Travel only if needed. Absolutely. Meetings that save travel costs and that can happen on Zoom should happen only on Zoom. We can achieve this iconic goal, and every single one of us is working towards it." So it's starting, ladies and gentlemen. Winter is here. Founders are reaching out to employees to buckle the cost belt and focus obsessively on the bottom line. It's the season of bad news for startups, right? Whether it is big markdowns in portfolios, look at Tiger Global. Look at SoftBank saying it's going to reduce the number of investments to a quarter, definitely a half, maybe to a quarter. Season of layoffs, whether it's Lido, Unacademy, Misho, Cars24, the list goes on and on. It is becoming more difficult to get checks from venture capital firms. Fear of missing out, FOMO, has turned into JOMO, joy of missing out. We've seen how the newly age listed companies are trading below their IPO price as well. It's a global phenomenon. Tech is falling out of favor when it comes to investors. But here's an early stage investor which continues to remain a bull. It's back with a new fund, 900 crore rupees. In fact, it even has a new name. It's Inventus, which is now going to be called Athera, which in Sanskrit means path. A 900 crore rupee fund by a venture capital firm which in the past has invested in firms like Policy Bazaar, which is of course IPO'd. It has sold Rebrands to Naspers. The list goes on and on. The portfolio on your screens. Joining me now is of course one of the big bosses from there, Rutvik, live with us here on Startup Central. Congratulations, you're back with a new fund at a time when most are struggling to even think of getting a check. I'm of course talking about the founder community. How easy or difficult was it to raise this fund? Did you want to raise more? And what was the reaction from the LPs and the GPs?
So thanks, Nayantara. No, you're absolutely right. I think this, the environment is very, very different from what it was in December, say, of 2021. But we've been around for a long time. We've been investing in this in India for a decade plus. And we are back with the fund, which is 3 times bigger than what our previous fund was. The previous fund was somewhere in the 360 crore range, and we are now at 900 crores, and hopefully we'll probably end up at slightly bigger than that also. We've been investing for the last 10 years, and I've done companies like Rebrands, Policy Bazaar, like you mentioned, and that has only deepened our belief in this country and the India opportunity. The way we look at it is, as early stage investors, once we invest, we are in the journey or the path of that company's growth for almost 6, 7, 8 years. So from our perspective, these economic cycles of ups and downs, they kind of average out. They are a blip in the large scheme of things. So we decided that we are going to not only double down, but we are probably going to triple down on the India opportunity, raise a larger fund, rebrand ourselves from a global name like Inventus to a very, very India-specific name like Athera, to kind of reinforce that we are an India-dedicated fund, and we're going to be sharply focused on India. And we look forward to investing many more red buses, policy bazaars from this new fund also.
So tell me something, we've seen the comeback of Policy Bazaar, PB Fintech, the parent company on the stock markets, the comeback of the fintech companies as well. So if I were to put you in a spot, and I know you have to love all your children equally, from your portfolio, what could be the next Policy Bazaar?
So if you were to, if I were to pick one company from the portfolio which is going to be the next Policy Bazaar, it's probably going to be Healthify Me. It's still probably 2 years away from reaching the same scale at which Policy Bazaar is, but looking at the way the company has been growing, it's just phenomenal out there. Just for those who don't know, it's India's largest health and fitness app. It's an app you download, kind of manage and track your fitness journey or health journey. We invested in them 6 years back. There were probably a few lakh rupees a month at that point in time. And as we speak, they're probably going to make $50 million of revenue this year. So the company has scaled very well. And, at least we are seeing no slowdown in the growth of that company. It has very, very healthy unit economics, which is what makes it sustainable and gives us the confidence that this company is going to be the next Policy Bazaar from the portfolio.
Okay, watch out for Healthify Me. I remember Vinod Khosla also invested in it recently.
Yes.
But Rutvik,
Yes.
Coming back to the larger environment, early stage investment, it's also risky. It's not as risky maybe at mid stage or late stage, but it's still risky given the larger environment. And now with, the bargaining power once again coming back to the VCs, how easy or difficult will it be to get a check from your fund? What will you be looking for?
So our belief, yes, it is absolutely risky, but our belief is that times like this is the best time to invest at early stages because it's a long cycle. When we look back, we did Red Bus in 2009, just after the Lehman Brothers crisis. We did Policy Bazaar in 2013, which was when the Indian economic environment was under question. There were several policy-related issues, and both those investments turned out to be our best investments so far. So during these times when there's a recession, founders take a step back. Founders are more geared towards building sustainable long-term companies as opposed to doing something which is very, very quick in nature, and valuations are muted compared to what it was during a bull run. So from an investment perspective, I think this is the best time for us to invest. And I'm glad we are out here with a new fund. Entrepreneurial energy in this country is on a secular rise. It is still far bigger than what it was 5 years back. So we don't see any dearth of opportunities. Our doors are open, and we will continue to invest in great founders who are building sustainable companies with a long-term point of view. And of course, we are early stage investors. So our sweet spot is those pre-series A, series A kind of segments in which we will invest.
So, we have early stage investors from a Lightspeed to a Tiger Global to Sequoia Capital, which have been so active in India. Sequoia, 24 hours ago, there was a 52-page slide, big presentation where it's talking about time to go frugal, time to obsess about the bottom line, time to increase the cash runway, to reduce the burn, to change the mindset. What are you folks looking at, and how are you seeing the larger environment? Because, do you now want startups to come to you and founders to come to you that are going to be giving you hyper growth plans, or a plan which will be like, okay, hyper growth for a year or two, and then here's visibility to profit or actual profit?
No, so we are completely aware of the environment. So when we fund companies, and especially at the early stages, the way we are going to solve this is that we are going to ensure that most of our companies have at least 18 to 24 months of cash runway at the time of investments. Some of them which were invested last year, we may support those companies to ensure that those guys have 24 months of runway, because the environment for raising follow-on capitals is not going to be as easy as it was probably a year back. So we are acutely aware of that. So ensuring that capital is there, ensuring that capital is being used in a sensible manner. Growth is important for venture capital investors. Growth is important for driving scale within a 5, 6, 7-year period. But our hope and belief is that if a company can survive this 24 months in a sustainable manner, while keeping an eye on growth, there is going to be enough capital available across most funds, was early stage or mid stage, to help them scale. At least because we're speaking of a 6, 7, 8-year journey over here, and not just a 2-year journey from our perspective. So ensuring that capital is available, ensuring that you're building it sustainably, but keeping an eye on growth is important. That's the way we are talking to our founders. That's the advice we give them.
Okay, but I'm also asking this on behalf of all the founders, startup employees, and there's just such a deluge of bad news out there, right? According to you, what is the right way to balance growth and a sustainable, profitable business? Are the days behind us now for burning cash for, customer acquisition?
I agree with that. I think the days of growth at any cost, where you burn money to just acquire customers, where you have no hope of recovering that customer acquisition cost, I think those days are behind us. Most investors are going to look at sustainable growth, which means if you're burning money to acquire a customer, there has to be a path of making money from there. Most VCs are okay to fund losses, but those losses have to be what we at least call in our industry fixed costs. That is, once you achieve scale, there has to be a path to profitability. I think that was something that was forgotten in the bull run of the last 18 months. It is back in fashion. And my advice to every founder is, or every startup at this point in time, is that if you're chasing growth, which is unsustainable, or where you're burning money with no hope of recovering that acquisition cost, it is going to be a tough ride. So you need to scale down and figure out ways to grow in a sustainable manner. And I think that's critical, not only for our companies, but that's critical for every company in the ecosystem at this point in time.
So now tell me something, if somebody wants to approach you folks for an opportunity, how is it being done? Because, I would imagine whether startups are now bootstrapped, pre-Series A, Series B, they're scared and they must be knocking on every VC's doors. Once again, if the bargaining power is back with the VC firms.
So our doors are open. We are fairly approachable, be it on our website, be it on our social media, be it through our other founders who know us or have been part of a portfolio, or just directly write to us on our email channels. We ensure that we respond to every founder who reaches out to us. So if you're building a company, you are in the early stages, looking for Series A to grow, and it's a tech-focused company, would love to talk to you, would love to explore if there are ways to partner.
So you don't need to be introduced, they can directly write into you?
They can directly write to us. They can directly write to us on our website. They can write to us on Twitter. They can write to us on email. Doesn't matter. Our job is to, go through every founder and, find the diamonds within the rough. So we ensure we look at every email and we respond to every deck or pitch deck that has been sent to us. Doesn't matter where it comes from.
But tell me something now with, tell me something with the cleanup act that's happening. We were hearing about how term sheets were being signed in like 48 hours. Obviously, it was also at the cost of due diligence. How long is it taking now to sign a term sheet?
So I think it's back to those old days when people try to get comfortable with the founders. At least I can't talk about everybody else, but from our perspective, we've ensured that before signing a term sheet, we spend enough time with the founders, we spend enough time with the company ensure that due diligence is done in the right manner, ensure that the value system between the founders and us, are at the same wavelength, and then go ahead and issue a term sheet. And that can take anywhere between 4 weeks to 8 weeks. I think most of our peers are also back to, taking that time. You started your introduction with saying that there's no more FOMO and it's JOMO. I won't say it's completely joy of missing out, but I think people are taking the time to ensure that they're making the right decisions. The FOMO is definitely much lesser in the market at this point in time, and which I think is a good thing for the ecosystem.
Okay. What is your advice to the bootstrapped startups? Because it's going to be tougher for them to raise funds. There are many of them may have founders who quit mainstream jobs to follow their dreams when the good times were here. Many are struggling to even pay salaries.
So my advice to bootstrap startups would be to stay put at this point in time. There is money available. It's not that money is completely dried out. Easy money is what has dried out. But if you're building a real business, if you have a growth plan which is sustainable, which which has the potential to become a large business in 5-6 years time frame, I think most VCs today are open to looking at them. There is still enough dry powder at the early stages. Growth capital is probably what has shrunk in this country, but early stage capital is still available. Most of us and our peers are still sitting on dry powder, and have capital to invest. So you should stay put and talk to all of us.
So okay. So that's the advice for all of you bootstrapped startups from a leading early stage investor. Many thanks for joining us today.
All right. Thank you so much.